So let's start. Good afternoon, everyone, and thanks for joining this afternoon's Cuppa Club with Simon Dukes, who's the CEO of Fair for You, and Emma Goodwin, who's the Deputy CEO. Welcome to you both. My name is Jerome Heusinger. I'm the Senior Development Manager at Ethex. We've spent many weeks conducting our usual due diligence on Fair for You. We'd like to thank the team for their commitment to this process. We're now proud to be hosting their second bond offer on our platform. Before we get started, there's some housekeeping to do. I'd like to let you know that the Cuppa Club is recorded and made available to watch, and we also edit this to a highlighted version. It is not a financial promotion, and if you do need advice, please talk to an independent financial advisor. The Cuppa Club is scheduled to run for 30 to 45 minutes. It's an opportunity to meet and ask questions of the team and hear about what Fair for You offers, its mission and vision, how it aims to achieve its goals, what your investment is funding, and the challenges and opportunities. Feel free, please, to ask questions in the chat box, and we will take questions as we go along. Just before Simon and Emma introduce themselves, let me say a little bit about the bond offer and what it's supporting. Following a very successful raise on Ethex last year, Fair for You have launched a new, if ISA eligible, 8% bond offer that will fuel Fair for You's expansion into Scotland, more of which later, unlocking 17 million in new lending, which will reach thousands of new customers on low incomes, part of vulnerable families who are in need of fair and affordable lending options. So Simon and Emma, why don't you introduce yourselves and give us some highlights on Fair for You and this offer?
Thanks, Jerome. Good to be here. And hello, everyone. Thank you, first of all, to everyone who invested in Fair for You in our last bond offer, and thank you to those of you who have, or at least are considering investing this time. Emma and I will introduce ourselves, and then I'll give a short intro on Fair for You, and Emma will talk a little bit more about this specific bond. So introductions, I'm Simon Dukes. I've been the Chief Executive of Fair for You for 4 years. I've spent the last 12 years reframing, scaling social impact and social enterprise organizations, not-for-profit organizations. Before that, I was a senior civil servant working specifically in defense and security and also cybersecurity. I was drawn to Fair for You really after reading Muhammad Yunus's book, Banker to the Poor. I recommend it if you haven't read it. But I've also seen through my government work close at hand the impacts of illegal lending and the harm that illegal lending can do to communities and to society. And that's why I believe it's vital that organizations like Fair for You can and should do more to meet the demand, the credit demand for short-term credit. Emma, over to you.
Afternoon, everyone. So I'm Emma Goodwin, the Deputy CEO here at Fair for You. I've been with the business for 7 years now, and it's been a very rewarding journey throughout that time. I trained as an accountant with one of the big four originally, built my early career in large FTSE listed companies. So when the opportunity arose to join something a little bit different, an innovative, customer-focused social enterprise, I was really excited to make that move. In my role at the moment, so I oversee finance, investor relations, compliance, HR and operations. So really working to ensure that our organisation runs efficiently and continues to deliver that meaningful impact to the customers that we serve.
Thanks, Emma. So a little bit about Fair for You, for those of you who don't know us already. We are a charity-owned ethical lender. We specialize in providing microloans, low-cost microloans, to people on low incomes, people with thin credit files, people with poor credit scores. people who have been excluded or are excluded from mainstream credit. Over the past 10 years, we have refined our algorithms coupled with technology such as open banking in order to be able to make good decisions to provide affordable and responsible lending for people who, quite frankly, have no other options to them other than the high cost predatory lenders or illegal lending. We do not lend cash. We never have done. It is not one of our strategic aims. We lend on a prepaid MasterCard, and that MasterCard can be used at one of our retail partners for the purchase of essential items for the home and family. This helps our customers help themselves. They are therefore not tempted to misspend the loan as it would be if it was a cash loan, for example. And it also gives some protection to those customers who may be suffering from domestic or economic abuse. Given a restricted card that can only be used with certain retailers is perhaps less attractive to an abuser than actual cash. Our customers are primarily female, aged mid-late 20s to 40, parents of school-aged children living in social housing or private rented accommodation, and with an annual income in the lowest decile of income in the UK. Emma, over to you for further details on this bond.
Yes, so our new bond raise is focused on extending Fair for You's reach north of the border in Scotland, where we know that the need for affordable credit is acute. So last year we partnered with TV presenter Gail Porter, who has struggled with some of these issues herself personally, to highlight Scotland's poverty challenge. You know, over a third of adults are currently living in financially vulnerable situations in Scotland. So we see a really strong alignment between Fair for You's mission and the needs of those Scottish communities. And this bond raise that we're looking to do will allow us to scale ethical and affordable credit solutions in Scotland, directly addressing those financial vulnerabilities and enabling us to measure the social impact of what we're doing as well. Jerome, back to you.
So,
Okay.
Jerome, if you've
Thanks.
got some questions for us,
Yeah.
that would perhaps help us to lead into further details and conversations about what we
No,
do and how we
absolutely.
do it.
Simon, you mentioned that you were owned by a charity.
Yeah.
Could you discuss that and your corporate structure and how
Yeah.
that differentiates and influences your corporate behavior?
Yeah, absolutely. You know, I said that we're a not-for-profit, but we're a not-for-loss. We're a CIC, and we've been financially sustainable for the last 10 years. Our 100,000th customer will be serving this year, which is very exciting. But our structure, we're owned by the Fair Credit Charity. It's a small charity. It exists to fight the poverty premium. The charity is currently chaired by former MP Tom Levitt, with various trustees some of whom have lived experience of poverty and financial exclusion. And the charity really exists to own the CIC, the community interest company that is Fair for You. But it also is the owner, if you like, of the values that flow through from the charity and through into the CIC. The CIC itself has its own board, a very commercial corporate board chaired by Howard Bell, the former founder of PayPal Europe. We have an impressive array of non-exec directors, details in the investment pack, who span a whole range of specialties and professionalisms which work towards our particular mission. The aim, I think, and the sort of the push, which I think is what perhaps you're getting at, is for the charity to push the CIC to do as much as it possibly can to serve the population, the demographic that we seek to do, but to do so in a way that provides the customer with the best possible value. And certainly, I'm sure we'll be talking about APR later. There is a constant push from the charity to reduce our APR, to make our services more affordable, to make our products more accessible, to ensure that we come up with more innovative ways to serve people who are completely excluded from mainstream finance.
Thank you. And having described that background, sort of your ethos and your purpose, let's tackle the APR issue, because since this offer went live about a week ago, and we experienced something similar last year, we received questions about APR. The headline rate is 65%. The question is that ethical? So please tackle that, Simon.
I will do my best. APR is a regulatory tool. The viewers will know that, your investors will know that. It is there to standardize costs across a whole range of different products in financial services so that people can make comparators between them. Our customers care about how much they pay back in total. They do not care about the APR number. And the reason is because APR is an annualized measure to show the cost of borrowing over a year. It works great with mortgages, with significant loans that are sizable sums over a 12-month period. But if the loan is for a few weeks or a few months, multiplying that interest rate into a yearly rate makes the cost look disproportionately high. So what do I mean? Well, if you take a £100 loan and you have that loan for a month, and at the end of that loan, the fee, if you like, the cost is £10. So as a borrower, you pay back £110 after the month. You automatically think, well, that's a sort of 10% type of interest rate. But the APR is far different because it has to be multiplied over the year. The APR is over 210% for a £100 loan for which you pay £10 cost over a month's period. So it is 64.8%, which is our APR, absolutely. But our customers will look at our sliders on our website to see how much they want, the term that they want it for, and they move the sliders around. We know this because we capture the data points to see how much they're going to have to pay back as a final sum. So for a real world example, if you borrow £200 from Fair for You and you borrow that for 5 months, you will pay back £36 of interest plus the £200 loan, so £236. So the final thing I'll say, I'm sure you've got further questions on this, Jerome, but the final thing I'll say is this, that if anyone watching really has 1.5 minutes, 1 minute 34 seconds to spare, they should Google Michael Sheen APR, and you'll see the actor give a real world example and a perfect example of why APR does not work for short-term lending. It's a really informative 1 minute 34 seconds. Michael Sheen APR video. If you put it into Google, it's a YouTube video and it's well worth a watch.
Thank you. That is really clear. Thank you very much. But let's just hang on to that concept of APR and let's look at that in the context of your business, because you have core loans, as you call them, shopping cart loans and food loans. And as the relative composition of those loans in your organization changes, am I wrong? But there is less of an emphasis on the need to even contemplate APR. Is that correct? And could you clarify that?
Emma, do you want to take this one?
Yeah, so I think it's really important to highlight that our Food Club product is a 0% interest product. So there's absolutely no fees and there's no interest charged on that product. And that is a growing part of our loan book. It's a product that we know our customers really value and find really useful. So as a proportion, the interest bearing part of our loan book is smaller in that regard. So yes, Jerome, APR is becoming, less of a topic of conversation because we've got this really valuable 0% interest product that we're really proud of and that we know our customers really value and that we're keen to develop, in terms of our growth and expansion plans. That 0% product supporting people with the real true essentials is where we see a lot of the growth in our business coming from.
Thank you. So I think we've dealt with APR quite comprehensively. You've referred everyone to that fantastic video, which I would endorse. I would also encourage people to go onto the Fair for All, the sort of the website where they have some very good materials on APR. So let's move on. You devote one of the first sections of your offer documents to the macro, the economic environment. Could you explain the background and what this means and what changes within it means for your customer base? It's our assessment that we're living in an increasingly bifurcated society, rich, poor, in which there's little awareness of what may be happening elsewhere. Could you shed some light on the reality that many people are having to endure at the moment?
Absolutely. I think it's fair to say that the situation for the customers that we're looking to serve is extremely challenging right now and has been extremely challenging for the last few years. Inflation is remaining high, static, but high. You'll have seen in the news today that food prices are continuing to surge. Even your budget supermarkets are saying that the cost of food is likely to have to go up. And it's those essential household bills of energy, water, food bills that are really impacting the household budgets of the people that we're looking to support. There's statistics around the increase in the annual food bill is, £1,000 higher than it was before the pandemic. Energy bills don't look like they're going down anytime soon. And it's putting that question of eating or heating firmly on the radar for a lot of people. There's also challenges, particularly when you get into energy, which people may be aware of, around prepayment meters and forcibly putting people onto prepayment meters and the pressures that puts on people when they're really struggling on a day-to-day basis. And I think what it means for our customers is that they look at their finances and they manage their money day to day. They don't have the ability to look forward, to plan, to have foresight, perhaps in the same way that some of others are lucky enough to do, because their income is inconsistent. And when those bills come in, they're just unable to manage how that's impacting on the overall amount that they've got left. So I think it's fair to say that some of the poorest people in our demographic are getting poorer and are finding it increasingly hard to stay with their heads above water. And what we've seen as well is that the people that we're looking to serve, that group of people is getting bigger. And it's getting bigger with people that perhaps we wouldn't have been looking to serve 5-6 years ago. So the working person is falling into a demographic that's now really struggling, where the amount that they're able to earn through working is not able to support a household with children in it. Gone are the days where one working salary is able to support a household of 4 people. We're just not there anymore. And I think, particularly with some of the changes that the government has announced or reversed in terms of benefits changes, has caused people a lot of anxiety, a lot of stress. They're not knowing how to plan for the future because they don't know what their overall income changes might result in. And they're looking at what options are there. Where can they go to support them when something happens and they need £250 that they simply don't have in savings to be able to support them with an unforeseen bill? And when you look at what's available, it's not much. There's some of the previous high cost short term providers, such as the Bright Houses of this world or Morse's Club and Provident, have gone. Credit cards and overdraft facilities might be there if they're available to our customers, but it's not likely that they are. And then you get buy now, pay later options, which are very popular, are continuing to grow. I think it's estimated that nearly half of all adults have used buy now, pay later. But nearly 25% of those people have missed repayments on it. And when you miss repayments on it, it suddenly doesn't become a 0% free option to split your cost. There's impacts and late repayment fees. And inevitably, given the way that the regulation is going and them having to report on credit files, that will impact credit files as well. And a lot of people aren't aware of how that buy now, pay later kind of mechanism works. So it's all well and good when you can make the payments, but things change when you can't. And if those options aren't available to you, where else do you go? With the range of credit options declining, it's creating an environment where illegal lending and loan sharks is what's filling the gap in demand. And I think that's a really scary prospect when you look at how many people in the UK have used or believe that someone in their household has used illegal money lenders. It's 3.3 million people. That's a huge number of people who are, exposing themselves to predatory individuals who are not regulated, have not got their best interests at heart, are not bound by consumer duty and some of the other things that all of our organizations are. And that's the realistic position for a lot of our customers, is they don't have the savings, they don't have the backup, they don't have the certainty of their income. And when they get those one-off shocks and bills, there aren't many options available for them to go. And that's why it's increasingly important that CDFIs, credit unions, and others in this space are able to step into that gap to keep people in a safe and regulated environment where they've got options to support them.
Thanks, Emma. That's a really powerful response. Could we talk about impacts for all of our investors? Impact is the first priority. And when it comes to impact, Fair for You, I think, are really good in its description and in its quantification. You have published some really interesting, deep research on the impact that's generated by your food loan activities with Iceland. And you also quantify a social impact of £16 for every £1 that is loaned. Could you just comment on your approach to impact?
Yeah, absolutely. You're right. I mean, just to be clear, we do not mark our own homework. Okay, we don't calculate our own social impact. It's independently calculated by experts. They use internationally agreed frameworks to make these calculations. In the past, these assessments on us have been made by the likes of the Centre for Responsible Credit and the Financial Inclusion Centre, who are experts in making calculations on social value. The calculation itself takes into consideration a number of different factors. It's calculated by linking an organization like Fair for You to its outputs, what it does, and the changes that those outputs make to people's lives. And then, where possible, attaching a financial value to those changes. So for Fair for You, clearly there's a monetary value that is accessible on how much you would save borrowing from Fair for You, as opposed to, for example, as Emma has just suggested, an illegal lender or a high cost short-term lender. That's very clear, and that can be calculated. Where the experts earn their money, I guess, is making a calculation on the value for example, from Fair for You, having purchased a bed with one of our loans, the value of a good night's sleep for you, the value of a good night's sleep for your children, the reduced stress in dealing with a Fair for You loan as opposed to a loan with another high cost lender. The improved physical health from better diet by having access to a fridge or a freezer. that you can get fresh food and keep fresh food for longer. And then once calculated, that value, that number is expressed as a ratio. And as you've said, for every £1 we lend, it creates £16 of social value. But what I would say, which I think we don't probably spend enough time emphasizing, is for investors, that number is even higher because of the nature of our business, the fact that capital is recycled because we're a short-term lender, money comes in, money goes out. Over the lifetime of a 5-year bond, an investor could expect their money to be recycled probably 5 times during the course of that bond, that investment. And what the experts have told us is that for every £1 invested, that creates £58 of social value. And that's what investors can expect, which is, as you've already said, absolutely stunning, really, compared with other social impact and social value calculations for other organizations.
Thank you. Thinking about bond offers, past and present, could we think about 2024, that offer that raised 130% of its target, which was £500,000. How has this money been used? And linking it into the impact question, what are the initial conclusions?
So thank you to everyone who invested in our previous bond raise. We were absolutely delighted with the amount that we were able to raise towards our mission. The investment provided, first of all, essential capital that enabled us to accelerate the lending that we wanted to do to financially excluded families. So with an average loan value of around, under £350, that support helped around 10,000 families to afford key essential items for their homes, which is, a wonderful statistic in itself. But that funding also acted as a catalyst for further growth. So it played a really crucial role in helping us to unlock commercial backing into the social lending space, which was the first time that this had ever happened for us. So in the latter part of 2024, we were able to secure a new credit facility from Shawbrook Bank, alongside a second facility from Fairfield Finance. So those partnerships have massively increased our capacity to support families. So, the funding streams are there to enable us to support a lot more customers to access the items that they need, whilst also supporting them to build longer term financial resilience. I think one of the other things that the investment really helped us with was around our technological development. So in 2024, we finished the replatforming of our website, which delivers a significantly improved experience for our customers. So that upgraded platform allows customers to manage their accounts online 24/7, to access real-time information about what's going on with their account. So ensuring a more convenient, kind of transparent service. And I think that self-service capability is particularly important for the families that we serve, whose, as I said, their financial situations can change really quickly. So it empowers them to be able to adjust their repayment plans whenever they need, to help them to avoid unintentional arrears, reduce their own stress and anxiety, and just give them a better capability to control their own finances and to control their account with Fair For You, which is something that we know that our customers really value and appreciate. So that investment has created real tangible impact in terms of the amount that we're able to lend, the number of families that we're able to support, and to help those families not just to get by, but to move forward and manage their finances with greater confidence and dignity. In terms of the social impact kind of side of things, so our last social impact report that we released was particularly on our food club product. Which this investment would have helped us to be able to provide lending on that product. This is the 0% interest product that I mentioned earlier that provides small sum interest-free credit aimed at parents of school-aged children to support them with the cost of food when their children aren't getting free school meals during the holiday times, or you've got big events like Christmas and things like that. So some of the statistics around that, the social impact that Fair For You was able to provide through that product are really impressive. So hopefully you'll see them all in the bond offer document, and that report's available online as well. But there's statistics around the number of people who in that position before the food club were finding things difficult, just about getting by, using food banks, weren't able to keep their homes warm in winter, and probably had fallen behind on some of their key bills like rent or mortgage payments. And then the impact of what life was like for them afterwards, having joined the food club. So half of those people were better able to cope with the cost of living pressures. There'd been a reduction in the number using high cost lenders, reduction in the number using illegal loan sharks, and reduction in the people that were having to use food banks, and improvements in how people felt, their mental health, their diets, and their overall health. So it's had a massive impact, not just in terms of the volume of lending that we can do, but the social impact of what we were able to achieve.
Thank you. Thank you. And as for the future, one of the main reasons for launching this new bond offer is to further your expansion into Scotland. Can you tell us a bit more about that and why it's an important area for you?
Yeah, absolutely. We are, as we said at the outset, we're a UK-wide lender. We have customers in all four nations of the UK. But we are particularly passionate about developing our proposition in Scotland. We believe there's a similarity between the customers that we serve UK-wide and the high level of numbers of those customers in the demography of Scotland as a country as a whole. And the reason why we say that is because during 2024, as Emma mentioned earlier, we worked with TV presenter Gail Porter and Scott as well. She herself has lived experience of debt, homelessness, poverty. And we worked with her to highlight some of the issues that Scotland is currently facing. The most recent reporting indicates that 36% of all adults in Scotland are living in financially vulnerable circumstances. Let me just say that again. 36% of all adults in Scotland are in financially vulnerable circumstances. And looking at Fair for All Finance survey, you mentioned them earlier, Jerome, and it's on their website, shows that a quarter of the Scottish population cannot pay for an essential item for the home of £500 without borrowing. So, and nearly 10% of those who were declined credit ended up going to a loan shark. So, aside from credit unions, Scotland is not well served for affordable short-term credit options. We firmly believe that Fair for You has a role in enhancing the availability of affordable and ethical credit in Scotland. So what we have done, and details in the pack, I won't repeat in any detail, but we've devised 4 specific initiatives which build on our existing value proposition, things that we've already mentioned in terms of the food club and the shopping cart in particular, but they are tailored to the demography and geography of Scotland. So the 4 that you'll see in the pack, we've given them 4 names. One is called Building the Base, and that's working with landlords and local authorities to ensure that people have access to some of the essential items that we provide loans for. The second one is called Community Multiplier, and that is providing our shopping cart, but on a high street, a local high street in a town, specifically, for example, in the Highlands and Islands, so that whereas the shopping cart currently is used with national, UK-wide actually retailers, this is going to be tailored to a specific high street. And we can do that because of the technology surrounding our card products. The third is called Keeping to Plan, and that provides incentivization through tie-ups with grant funders, but also with the likes of crowdfunder to help people with an incentive to keep to the payment plan and perhaps have the last 10% of their loan written off. We found in trials that we've done in the southwest of England and actually in Scotland that payment plan adherence increases by about 36% if you tell someone that if they keep to plan, the last 10% of their loan or last 15% of their loan is going to be written off. So that's a good option. And of course, every time somebody repays their loan and keeps to plan, their credit file is repaired. And every time it's repaired, their credit score goes up. And what we want as a charity-owned lender is ultimately for people to say, actually, Fair for You, thank you so much. We don't need you anymore. We can get mainstream lending because we have a better credit score. And the fourth one is called highlighting the alternatives. Again, we've trialed this in England, where we work with local football clubs to highlight the alternatives to some of the high cost credit that's available out there, working again collaboratively with credit unions, with other CDFIs like us, community finance development information institutions, so that we can get across to people in a safe environment, a trusted environment, the local football club, that there are responsible credit options out there for you. And in doing so, we strongly feel, you'll see from the pack, that we've got a great offer, not only for the people of Scotland, but also to provide a really firm level of increased lending to the demography in Scotland that clearly, from that data that I gave you right at the start, clearly is in dire need.
Thanks, both. That's a great answer. Just a couple of financial questions. So this will be the second bond. How will the bonds be repaid in 5 years' time?
So our intention is that the investments in the bond will primarily be repaid through operational cash generation, or they'll be refinanced out.
Okay, thanks. And just a question on recent trends in credit. I mean, you term the phrase that you use net bad debt rate. So what is that, and what have the recent trends been?
So our net means the figure after recovery. So our goal is always to avoid customer defaults. So a customer defaulting gets that default marker, negatively impacting their credit file. And our aim throughout our entire collections journey is to work with the customer as constructively as possible to avoid having that, because that default marker then stays on their file and impacts them for years in the future. So we operate, as I said, with a lifetime net provisioning rate of 12%. So that means that when customers are unable to pay their loan anymore, we will provision them. That's our kind of gross provisioning. And then net means after any recoveries that we receive. So customers who re-engage with us, come back on a payment plan, or we may get recoveries through the DWP's benefit deduction scheme. It's at the bottom after all of those recoveries. That's our provisioning rate. So I think one of the things that I would like to highlight here is that our customer journey is designed to minimize provisioning risk. So we built our journey deliberately customer focused with flexibility. So our customers can align their payments and their repayments with their income and their financial circumstances, and they can change that whenever they want, as many times as they want. So we know that our customers' lives are sometimes chaotic, that their income doesn't match their expenditure and it's inconsistent. So having a set repayment timeline and a set repayment rate often doesn't work for them. So they can move it around. They can change the frequency, they can change amounts, they can double pay 1 week if they've got more funds than they expected to make up for missed payments. And that's all done whenever they want, with no fees for doing so and as many times as they want. And they can do it all 24/7 throughout the account area that's on there through the website. And that's really important to enable them to minimize the risk of them reaching that stage where they need provisioning, and to provide them with as much support to be able to keep making payments, to keep them on a plan to protect them and their credit file. And once provisioned, we stop charging any interest if it's an interest-bearing loan, and we will not reinstate any interest on the loan, even if they continue to start repaying us back. So there will be no further interest charged on the loan at that stage. And the approach has been designed to support loan book stability, protect customers, and also think about the kind of the sustainability of the organisation. Now, we know that, as I said, customers have, some challenges sometimes from a financial perspective. So, it's important that we highlight we don't charge any late fees, we don't charge any missed payment fees or any admin fees at any stage of the loan life cycle with us. All of our loans are unsecured. They're managed entirely in-house. We don't sell our debt on to anybody else to work or interact with our customers. As I said, those repayments are flexible by design. Our interest is calculated daily on a reducing balance basis. So any missed or late payments will only result in a slightly higher interest accrued over the life of the loan because, the balance is slightly higher than perhaps they would have been if they'd made their payments on time. And we have a multi-channel communication strategy. So we work with our customers via phone, via email, via SMS. They can go, as I said, onto the account area and kind of make changes to their account there as well. And that approach emphasizes early informal contact to re-engage customers and support repayment where we can. If a customer is particularly struggling financially, we'll look at suspending interest if it's an interest-bearing loan. We'll work with them on an income and expenditure form so we can get a proper position of what's going on for them financially, what might be the right thing to do. And so that works for some of our customers. We'll also take reduced payment plans. So if a customer had originally contracted to pay £10 and they can't make that £10 anymore, but they can make £8, we'll work with them to take the £8. As I said, there's no fees for doing that. All that will happen is that they'll pay a slightly higher amount of interest because the loan agreement is expecting £10 versus the £8. And, that's the main focus for us is how can we keep a customer being able to repay something that's manageable for them. So our focus is always on a manageable and sustainable payment plan that they're going to be able to continue to pay so that we can continue to report to the CRA that they're repaying it for the benefit of their credit file.
Thank you, Emma. That's such an important answer and so detailed and so far removed from the sort of stereotypical bailiffs who reclaim unpaid debts, which people perhaps associate with the darker parts of an industry. And you are so different to that. So we have a question from Ken, and I should have asked this earlier on. So we've covered APR, but how can you offer so high a rate of return on this bond when your clients are in such financial difficulty? How is that compatible?
Well, I mean, Emma, you'll want to come in as well. I mean, we've covered the APR, and Ken may have missed that aspect to it. But just to emphasize, I don't believe that the APR is high for the amount of money that people pay back for their loan. APR is an annualized figure. We've covered that. Happy to go through that again, Jerome, if you think that's of use. But the interest rate we're paying our bond investors is the cost of capital that we then use to lend. And the interest paid by our customers, it covers the operational cost of the lending. So proportionately, reducing the cost of the capital would not impact really on the operational cost of actually doing the lending itself. And given that we go from 0% at one end of our food club through to 64.8% for our other products, collectively our APR, what we're charging our customers, is, I would suggest, the lowest collectively in the CDFI sector. Emma, anything you want to add on that?
Yeah, I was just going to add that one of the unique things around our business model is linked to the fact that we don't lend cash. So because we lend on a prepaid card or for a specific loan item, we have bespoke relationships and contracts with retailers that we work with. So we're able to earn commission from the retailers that we work with that helps to support the P&L in terms of being able to cover the cost of capital, cover the operational cost of lending and our own operating costs, balanced with the APR that we also receive.
Okay, thank you. I think we've got to the end of the my questions and the online questions. If any of you think of something subsequently, then please don't hesitate to reach out, and we will endeavour to get you very comprehensive answers. I will just conclude really by saying that this 5-year bond is open until December. You can invest up to £50. and target a potentially tax-free return of 8%.
From £50, Jerome, not
From
up to.
from 50. I'm sorry about that. We'll be sending updates on the progress, so make sure you're signed up to get emails from us, and you can see how the offer is progressing on our website at ethex.org.uk. Simon and Emma, do you have anything else you'd like to say in summary?
Well, I mean, we won't repeat ourselves. The story of Fair for You over the last 10 years has been about tackling financial exclusion, as you've heard today, making a real difference to people's lives. We are really excited about our plans to do more in Scotland. We can only do that with your support. If you invest in the Fair for You Scotland bond, your investment will provide a social return over the 5 years of £56 for every £1 invested. That is a phenomenal return on investment. And you, of course, will receive an 8% per annum, as Jerome has said. Our vision, our stated vision, is to change lives through better lending. With your investment, we will be able to change many, many thousands more. So thank you.
Well, thank you. Thank you both, and look forward to catching up soon. Goodbye.
Thanks.
Bye.